Today, Mr. Sathya Poddar is here to deliver his speech on the GST, including payment return, refund and registration process.
I'm pleased to be here with you, and in a few days' time, we'll find out whether this presentation was worthwhile or a total waste of time. As you know that beginning today, the Constitutional Amendment Bill is going to be debated in Rajya Sabha for the introduction of GST. And this evening, Prime Minister Modi has invited Sonia Gandhi and Sri Manmohan Singh for a Chai Pe Charcha. And the main topic of discussion will be the GST, trying to reconcile the differences between the government and the opposition party so that Rajya Sabha does not lead to a blockage of the GST. So with that degree of uncertainty, it's very difficult to get into the technical details of the design of the GST. So what I've tried to do in the presentation is to stay at a very high level and give you a broad perspective. Why there is such a clamor for the GST? Why does country need a tax like GST? And why there has been so much delay in its implementation? So bear with me, and I hope that this broad macro perspective on the GST will be of some use to you in understanding how to comply with the GST laws if it does become a reality. Now, I want to say that in my view, GST is not a good and services tax, it's a good and simple tax. That's my ideal. And the test for you is to decide whether the GST that is going to be enacted is truly good and simple tax. Does it deserve the label of good and simple tax, or it just becomes a GST, which by the way means goods and services tax. Now, in order to understand why the GST is to be introduced, let's look at the system that we have today, because if the GST is going to be beneficial, it necessarily means that the current system is flawed and it's not very beneficial. Now, in order to explain the current system, I have divided the economy into 6 boxes. You have the green boxes: primary producers, manufacturers and distributors and resellers. These are the 3 boxes of the supply chain for the goods. Then you have 2 boxes for the service providers and service resellers. And then you have a last box which is the real estate. Real estate is neither a good nor a service, so it falls in the box of its own. So now think of these 6 boxes that comprise the economy. Now you have 2 levels of government in India, the states and the center. Both are empowered to levy the tax on some of these boxes. And which boxes can be taxed by which government is governed by the Constitution. In the Constitution, you have 2 lists, the state list and the central list. And the state list defines the taxes that can be levied by the states, and the central list has the taxes which can be levied by the center. Now, the way the Constitution is drafted today by Baba Ambedkar, and yesterday was Baba Ambedkar's anniversary celebration in Rajya Sabha. Under the Constitution, neither government, neither the states nor the center can levy the tax on all the 6 boxes. The states can only levy the tax on sale and purchase of goods. So on the state list, I have the 3 boxes in green. The states cannot tax services at all, nor can they levy the tax on the real estate, sale and purchase of the real estate. They can levy the transaction taxes, the stamp duties, but they cannot levy the tax on sale and purchase of real property as such. Now look at the center. the center can only tax manufacturers. They cannot tax resellers, distributors, wholesalers and retailers. So you have only one box which is green in the goods supply chain in the central category. The center can tax services. So the service boxes are all green for the center. The center cannot tax real estate. So what you have is, sorry. So what you have today is the states can tax 3 of the 6 boxes, the center can tax 3 of the 6 boxes. And this is the root cause of all the difficulties that arise under the current tax system. This partial application of both the center and state taxes leads to shrinking of the production pie, the GDP pie. It creates jobs for you and for me. If all the 6 boxes were green, you will not have half of the work that is left for you to do. And I'll be out of business. And the reason this system creates so much work for us is because, first of all, you have to define which commodities, which services go into which box. You've heard the case of the works contract. Works contract is neither the supply of goods nor the supply of services. So they could not be taxed by the state governments as one of the green boxes. So the constitution had to be amended to deem the supply of works contract to be supply of goods. The same thing is true for services. Right now you have a lot of confusion whether the restaurant meals are a service or sale of goods. Hospital services, when you get a prescription of the medicines in a hospital, can it be taxed as a good or a service? Telephones, there have been 4 Supreme Court judgments whether telecommunication is a supply of goods or supply of services. And the last judgment was in 2006, if I recall, where Justice Ruma Paul gave the judgment that the telecommunications is not a supply of goods, not a supply of anything that the states can apply the tax to, it is only a supply of services. Now, if the Supreme Court has to spend so many years of its time in debating whether telecommunication is a supply of goods or a supply of services, you can imagine how much job it creates for us and you in making a living. So, this type of a division of the constitutional powers between the center and the states is very unique to the British colonies of India, Pakistan and Bangladesh. No other country in the world has a division of taxation powers between the 2 levels of government of the type that India has got. And that is the legacy that we have inherited from the British Empire. So first point is that this division of taxation powers creates a lot of classification disputes. More importantly, this division of taxation powers creates very significant inefficiencies in the economy. And the inefficiencies arise as follows. The green box says pay tax on their sales or their output. The white box says cannot be taxed on their output, but they pay the tax on their inputs. So all the inputs that go in the telecommunication service, which is a service sector, they cannot be subjected to the VAT on output, but all the inputs that come in, telephone towers, switching equipment, transmission lines, all of them will have the VAT applied on them. And that VAT is not VATable because their output is not taxable. Telecommunication services are not taxable. So the white box says pay tax on production costs, while the green box says pay tax on their output or the turnover. Now when you apply that tax on production costs, what will be the consequence? Production will suffer. Domestic producers become uncompetitive in the global market. And as a result, the GDP pie shrinks. The sole purpose of the GST is to remove the tax on production and move it from production to consumption, which is the output. And in the economic jargon, people call it cascading. When you have a mix of green boxes and white boxes, huge amount of cascading is created in the system. Cascading is application of tax on production inputs, which is not recoverable, which is not vatable, which is not sand-vatable. And that tax on production inputs leads to inefficiencies in the economy. And that inefficiency arises under both the central taxes and the state taxes. The next point is that, let's go through some more, the inefficiencies of the current system. One is cascading. So all the inputs that go in the white boxes are subject to input taxes, which is not recoverable. Today, approximately 1/2 of the state VAT and 1/2 of the central excise duty is collected not from the final goods sold to final consumers, but on production inputs. So it's not a trivial amount. Next problem with the current system is economic distortions. The biggest distortion arises under the central tax. The central excise duty is basically tax on manufacturing. It's a tax on production in a factory. Now I'll give you an example. Suppose you have this table. If you make this table in a factory, it will attract the VAT of 14%. It will attract the central excise duty of 12.5%. So cost of making this table in a factory is 26.5% more. If you make the same table on site, you bring the lumber and you bring the carpenter, he makes a table on site. There is no VAT on the labor of the carpenter, and most likely there will be no service tax or central excise duty on the labor of the carpenter. So the current tax structure encourages manufacturing on site, outside the factory. Now, you say, what's wrong with it? The biggest thing that is wrong with it is because efficiency of production is much lower on on-site construction, on-site manufacturing than in a factory. In a factory, you can standardize the products, you can have the economies of scale, you can have better quality outputs. But on on-site construction, you don't have any of these. I'll give you another example. Garments. You make garments in a factory, you pay the excise duty and the VAT. But if you buy the fabric and go to the tailor, you don't have to pay the VAT on the tailoring charges, nor the excise duty. Third example I can give you is construction. Historically, all of the construction in India was brick and mortar construction, where you buy the construction, you hire the construction workers, and they'll build the building on site, they'll dig the foundation and do everything else. Today, most of the modern construction is really an assembling operation. The buildings are made of structural steel. The structural steel is formed in a factory. Then you have the glass windows, almost the complete wall of glass. That glass is also made in a factory. And all you do is you bring the structural steel and you bring the windows to the site and get a screwdriver and start erecting the building. You can erect those buildings in 5, 10, 16 months compared to 10 years it will take you to erect a building at the on-site. So today, if you see airport construction, all of the airport construction is factory construction of structural steel and windows and other fixtures which are brought to the site and assembled on the site. Now the difficulty with that is that any kind of factory construction attracts the 14% or 6% VAT plus a 12.5% excise duty. The same construction, if it was done on site under the traditional methods that we are used to in India, the cost will be 15 to 20% cheaper than otherwise. When I came in 1992, I had a meeting with Manmohan Singh ji, who was the finance minister at that point in time. And he had difficulty understanding how the current tax system is biased against factory construction. I said, look at your office. There are 12 windows in Minister of Finance building. office in the North Block. I looked at those window frames. None of the window frames in that building in North Block fitted exactly the space created for the window. All of the windows had some defect or the other. The glass, the window frame will not fit. I said, look at these windows, sir. All of these window frames were made on site. As a result, none of them fit properly, and all of them are second-rate, poor quality windows. Had those windows been made in a factory, you will have better construction of the window frames and better quality fixtures. But it was not possible because that would have attracted excise duties. And in those days when the building was built, excise duties were perhaps at 25-30% tax rates. So these are the examples of the economic distortions created by the current system. Another point is import bias. When you import the goods from abroad, you don't pay the state VAT. You only pay the excise duty as a CVD. So it creates a bias in favor of imports. Now, you think of the Prime Minister's economic objectives that he's talking about: make in India, promote manufacturing. And all of those goals are blocked by the current tax system. And that's why there's such a clamor in the country for introducing the GST, which will not have these biases. Balkanization of the common market. Today, in an ideal system, regardless of where the goods are manufactured or produced or supplied from, the tax should be dependent upon where the goods are consumed. But this is not the case in India today. And why not? Because of the 2% CST. I'll give you a simple example which was published in the newspapers. There was a manufacturer who wanted to manufacture some parts in Delhi, National Capital Region. He could not set up the factory in Delhi because of the environmental conditions and restrictions, and land is very expensive. So he decided to set up the factory in Haryana, in Gurgaon, which is literally 5-10 kilometers away across the border. Raw materials were still coming from Delhi. So every time he bought the raw materials, took them to his factory in Haryana, there was a 2% CST applied. Now, Haryana manufactures the product and brings it back to Delhi for consumption. Again, the 2% CST applies. So by setting up the factory in Haryana, for catering to the Delhi market, he had to attract 4% additional CST, which is not recoverable tax. Had the factory been set up in Delhi, that 4% tax would have been reduced to zero. So this is an example of balkanization of the common market. And the supply chain gets fragmented. You are aware of, rather than making an interstate sale, you make a consignment transfer or a branch transfer, then you make a local sale through the consignment agents. Narrow base and higher tax rates. I don't have to tell you how high the tax rates are. The state VAT rate is up to 14%, 15%. Central excise duty rates are 12.5%. Service tax rate is 14%. These are very high tax rates. The highest VAT rate in the world today is 25%. And that's in Denmark, Sweden, Finland and Norway. And those countries have reached the limit of applying the VAT at rates any higher than 25%. India is still talking about applying the GST at R&R of 27%. And the complexity. I think the very fact that the room is full with people like you with so much of talent and genius is because the system is very complex. Now, how will the GST change this picture? GST has been called the game changer. Under GST, ideal GST, all the 6 boxes become green. And those boxes become green for both the state governments and the central government. Now this is a very significant change. And it requires amendment to the Constitution. Because in order to allow the states to levy the tax on services and real property, they have to amend the Constitution to broaden their taxation powers. Same thing is true for the center. So the proposal was that both the center and the state governments will be empowered to levy the tax on all the services and goods in the economy. All the 6 boxes will become green. And that was called the grand bargain. So this was the concept initially proposed back in 2002 when there was a committee set up for tax reforms. And then soon after Chidambaram announced that the government will go to the GST after the VAT, the 13th Finance Commission prepared a report on the design of the so-called flawless GST. And this was the model of the flawless GST. All the 6 boxes for both levels of government become green, and both governments will acquire powers under the Constitution to levy the tax on any supply in the economy, regardless of whether it is of goods, services, mix of the two, or the real property. Now, there's one other unique feature of this tax, this grand bargain. Number one, both governments will acquire the power to tax everything in the economy. More importantly, the powers will be concurrent. Under the current constitution, the powers are mutually exclusive. If the center can levy an excise duty on manufacturing, the states cannot levy it. If the states can levy the tax on sale and purchase of goods, the center cannot levy it. So the powers are divided in a mutually exclusive fashion. The GST was meant to be concurrent. Both governments can levy the tax at the same time on the same supply without the principle of mutual exclusivity. Now this was the concept. And this type of a GST would have led to more investment and more output. How does the GST lead to more investment and output? I have a formula which I call 2488. 2488. Remember those 2488 words. The last 8 of 2488 is the amount of tax that applies on investment goods. Today, approximately 8% of the tax on capital investment is not recoverable, is not VATable. For example, if you make a building construction, no amount of tax on the cement and steel that goes in building construction is recoverable today. Under the state VAT law, no recovery is allowed. Under the central excise duty, no recovery is allowed for inputs that go into a civil structure or construction. So these taxes which apply on production inputs of a capital nature, which are not recoverable, are roughly 8% of the total quantum of investment taking place in the economy. So that's 2488, the last 8. The second 8 is that if you assume that the demand elasticity is 1, 8% reduction in the price of capital goods because of the GST will lead to 8% more capital stock. Okay, that's the second 8. Now what is 4? 2488. What is 4? In India, the capital output ratio is 4. That if you have 4 rupees of capital, you can have 1 rupee of output. So if you have 8 rupees of extra capital, because of the last 2 8s, then given the capital output ratio of 4, you have 2 rupees of additional output. That's your 2. So 2488 is the formula that can be used to explain how the GST can provide a boost to the GDP. You've heard about the story in the newspaper estimates that the GDP can go by 1 to 2 percentage points as a result of the GST. This is how the 1 to 2 percentage point growth is coming from. Efficient resource allocation. Under the GST type tax, there is no bias in favor of factory or against the factory construction, on-site construction. Everything is treated uniformly. And this uniform application of tax to all modes of production and all goods and services produced in the economy leads to better resource allocation, and that leads to more GDP. Comprehensive base. Under the 13th Finance Commission paper study they have done, they estimated that the revenue neutral tax rate for the GST can be less than 12%. In fact, it was 11.3%. And they rounded it up to 12%. And it was meant to be 7% to replace the state taxes and 5% to replace the central taxes. So 12% is all you need, and I explained to you more why this rate is more than enough to replace the current mess we have on the tax system. Common market. Once you abolish the 2% CST and the GST regime, you'll have a common market. Regardless of where the goods are produced, the tax content will be the same. It will depend upon the state where the goods are consumed. Simpler compliance and effective enforcement. Needless to say that simpler the compliance, better the tax system, better will be the revenue collections, and enforcement will not even be needed in that case. In most countries where they have a comprehensive GST, it doesn't take much more than 3-4 hours a month to complete the VAT returns and pay the taxes. In India, it's not 2 hours, 3 hours, 4 hours, it's perhaps several man hours, hundreds of man hours that companies spend in complying with the tax laws. I think this is another chart. I may be belaboring the point, but I think you'll find it very useful to understand why the GST and how does it function, and then you'll be able to evaluate whether the compromises that are being imposed by politicians on the design of the GST are worthwhile, are good or bad. This is a flow chart of how the GDP is enhanced by the GST type tax reform. So you're starting with a sales tax reform. It doesn't show. Okay. You have the sales tax reform, then you have 2 cycles. This is called the capital deepening cycle. A sales tax reform leads to lower cost of investment, which leads to more investment, and which in turn leads to more GDP. So this can also be referred as capital deepening cycle. Other side is called the factor productivity improvement. And the factor productivity improvement is the cycle that can be illustrated by removing the bias against factory construction, on-site construction, tailoring of the garments in a factory versus by the tailor. All of those things contribute to, when you remove all those biases, your GDP production becomes more efficient, your productivity goes up, and both of those factors lead to improvement in overall GDP.